Hi CA students, let's revise CA Final AFM Chapter 6 Portfolio Management. Practical question 33. An investor holds two stocks A and B. An analyst prepared ex ante probability distributions for the possible economic scenarios and the conditional returns for two stocks and the market index as shown below. Economic scenarios are given for growth, stagnation and recession, and probabilities are given, and conditional returns are also given for A, B and the market also. These are returns in percentages. The risk-free return is given as 11%. Determine whether the investor should liquidate his holdings in stock A and B, or on the contrary make fresh investments in them. Either he should liquidate or make fresh investments. They told CAPM assumptions are holding true, so CAPM can be used to find out the returns, and then we can compare the returns. Now first thing, what is this ex ante probability distribution? So ex ante is nothing but before the event. So simply it's nothing but the projections. An analyst has prepared some projections and has given some probabilities, like on what basis this returns will happen based on the economic scenarios he has given. If the economy is in growth stage, then the possibility of the returns in market is 18, and then B is 20, and then 25. In recession, the interest rate will be negative. That's what he has given us the projections. And risk-free rate for the year is 11%. Okay, before comparing like what to do, whether to liquidate or make fresh investment, we need the expected return and we need the CAPM return also, and we need to check how much excess return the stocks are giving to analyze whether to invest more or liquidate. Okay, for that anyway we need CAPM also, CAPM expected return, and the normal expected return. So the expected return based on the analyst, if we calculate, we have to just multiply with the probabilities to get the expected return. So going to the solution, the expected return for stock A is 11.5 and 10.1 in case of B, and in case of market it is 10.2. So as you can see, 0.4 multiplied by 25 plus 0.3 multiplied by 10 and then 0.3 multiplied by 5 will give us the expected return. And in all other cases same thing, 20, 15 and 8 multiplied by 0.3, same way for market also. Now we have got the expected returns. Now we need the CAPM return. For CAPM, the formula will be, for CAPM expected return, the formula will be risk-free return plus beta into RM minus RF, whereas the RM minus RF will be the market risk premium, and RF is the risk-free return, and beta signifies the sensitivity of the stock's return towards the market. Now we need, since we have we have the expected return of market and then we have the risk-free return also. So we got the market risk premium and risk-free return also we have. Now beta we need to calculate. For beta we need covariance of the stock's return with the market's return and divided by the variance of market return. Now how will we get the covariance of the stocks return with the market? For that we can use this formula, summation of the return, the possibility of return minus the expected return multiplied by market's return minus the expected market return multiplied by the probability. So we have to do it in all possibilities. So 25 minus 11.5, which is for expected return of A. So 25 minus 11.5, 10 minus 11.5, and then minus 5 minus 11.5 multiplied by 18 minus for market return it is 10.2. So 18 minus 10.2, 13 minus 10.2, 3 minus 10.2, then multiplying whatever we got, right, multiplied with the probability will give us the covariance. So summation of all the possibilities as shown here for covariance A and M. So here covariance for stock A with the market. The same way for covariance for stock B with market. So we'll instead of A we will be taking B. So 20 minus expected return in case of B is 10.1. So 20 minus 10.1, 15 minus 10.1, then minus 8 minus 10.1. Multiplying with this deviation of market with the probability, and summation of those will give us the covariance of stock B with the market return. Using these two, covariance of AM divided by the variance of market return. Okay, so variance of market return, how we will get? 18 the market return minus the expected market return, 18 minus 10.2, then 13 minus 10.2, then minus 3 minus 10.2, then square will give us the deviation, and the square of this deviations multiplied by the probability will give us the total variance. Okay, now using these two values we will get the beta. Covariance of AM divided by variance of market will give us the beta for stock A, the same way for stock B also. Okay, now we have risk free return, then risk premium also, then beta also. Using this we can find required return for A based on the CAPM model. So the required return for A is 9.924 and the required return for B is 9.92%. Okay, then going ahead, we have the expected return for market A and B, and we have the required return for market A and B, sorry, stocks A and B. Now alpha will give us the extra return, how much we are earning from the stock, right? So the expected return minus the CAPM return will give us the alpha, Jensen's alpha, which is nothing but the extra return we are earning from a stock. If it is positive, that signifies we are earning extra from the stock. If it is negative, then we are earning less only. Sorry, we are earning on a deficit basis, not extra. So here both values are positive, so both values are giving more than whatever is expected or more than what it is required under CAPM, which is a theoretical basis. Okay, now as the expected is more than, sorry, the expected is giving expected minus the required return is giving a positive one, hence the alpha is more than 0, hence the stock is underpriced. So we can go ahead and invest or buy in both the cases, in case of stock A and stock B, or in a portfolio basis we can go ahead and invest. Now why the prices are underpriced? So why the stocks are underpriced? If the returns are giving extra, so if the alpha is greater than 0, then the stock price is underpriced. Now we have the question, even though we are earning extra return compared to the required return under CAPM, the stock price, why we are telling it is underpriced? This is because if we are getting more return than expected, that extra return must be coming from price which is being lower than its fair value. This is mainly because the market price was lower than its true value, which is the intrinsic value which we found out using CAPM, right? Hence that lower price will give us the higher return and which lead us to the positive alpha. Hence the stock is underpriced as of now. In future, it will go and attain an equilibrium stage, so it will, the price of the share will increase, wherein again we'll get a gain. That's why we have to invest or buy. And if it is the ulta case wherein the alpha is less than 0, then the case is overpriced and we have to sell the shares. If the alpha is 0, then it is considered as fairly priced, as the expected return and the required return as per CAPM is same, so it is not giving anything extra, which is 0. So we should either hold the investment or decide based on portfolio. Why deciding based on portfolio? Because I might be an investor aiming on capital appreciation, or I may, if I'm in a short term position, or I want to hold the shares for just short term, or if I'm in a long term position, if I'm thinking, then I just only want the returns coming from this stocks, and I don't want any capital appreciation or something like that, then I'll hold the shares and then just get the dividend or whatever the returns the investment is giving. That's it. Thank you.